So hello guys and welcome back to another live stream. Thank you so much for the support you guys have been showing me in the past few days. It's really incredible. I really appreciate having each one of you guys here in this live stream. So today we're gonna cover a lot of important topics. We're going to talk about different stocks. We're gonna analyze them together, and we are going to do a lot today. So guys, please stay with me on the live stream because today I'm going to break down the difference between smart money and retail traders, why most traders enter too late, the accumulation to distribution cycle, how institutions use the liquidity, and the warning signs most people ignore. Then we're going to analyze stocks. Good morning, Leon. How are you doing? How was your day? Thank you so much for joining the live stream. And thank you for your comment, Leon. I really appreciate it. So, as I told you guys, today we're going to have an intraday analysis of many different stocks, indices, and commodities, okay? So stay tuned. We're going to analyze this week's news and we're going to do a lot. So we're going to monitor the BDA situation, okay? That's one of my favorite words of these past few weeks because we've been going through a lot these days and we are still going through a lot. So let's see how the oil market is doing. We are still on the same levels. We can see some resistance from support from in around 92, okay? So we can still see that Wall Street is on track for a 4-week losing streak. And let's see this through, okay? Let's make a weekly chart. Weekly chart, yeah. So if you guys can notice, this is the 4th week on a row where S&P 500 is suffering major losses. So we started the 23rd of April of February at 6,901 and now we're at 6,606, which is very bad, okay? It's very bad. The situation is getting worse and worse. Same thing for Nasdaq. If you go to the Nasdaq, nothing's gonna change. We're still facing. Oh, okay, all right. So Nasdaq is good. Nasdaq is still okay. The S&P is the one suffering a lot. So here we're gonna analyze all the news of the market. First of all, let's go through this article. First of all, the US stocks were under pressure on Friday as investors are gyrated. Okay, so Dow futures fell 0.2%. Same thing for the S&P, the skipped 0.2%, and the Nasdaq dropped 0.3%. So all the major US indices are suffering major big problems, okay? So I am telling you guys, it's actually really, the situation is very bad for the market. Many different stocks are facing huge problems in today's economic conditions. And yes, it's all due to the Middle East, okay? So the Middle East problem is causing a lot of important, I can say, problems for the world. An attack by Israel on South Port, the Iranian sector of the world's largest gas field, was met with retaliatory strikes from Tehran on key energy infrastructure across the Middle East, and specifically a major natural gas production hub in Qatar. Brent crude prices spiked as high as roughly 119 a barrel, while US benchmark natural gas monitor also surged. Stocks rallied from their lows and oil fell from its highs, thanks to an effort by the US and Israel to signal that no follow-up strikes would hit southwards. The White House has also been outlining plans to elevate the stress in energy market and even lifting sanctions on semi-radial oil, as they did with some Russian oil that has already been out of the market. So Qatar's major natural gas production facility was hit by Iranian strikes, has said that its export capacity has been reduced by 70% and will take as many as 5 years to repair. The country is a major gas exporter, especially to Europe, where the regional natural gas benchmark has surged and driven worries over a spike in inflation. The New York Times reported that Iran has continued to launch retaliatory strikes with countries around the Middle East allied with the US, saying they were facing incoming drones and missiles. So, as you guys can see here, the situation is good. It's getting intense. It's getting more dramatic at this point, okay? So the situation is becoming more and more dramatic throughout the days. And yes, as you guys can see here, Brent prices hover around $107, with US considering measures to boost supplies. But there's no way to do it. Oil prices oscillated around the flat line on Friday after US officials said Washington may soon lift sanctions on Iranian oil already at sea, freeing up more supplies. Hopes for some de-escalation in the US-Israel war on Iran had earlier weighed on crude, helping underpin the sentiment where US calls for Israel to hold off on future attacks against Iran's energy infrastructure. So, US is looking to lift sanctions on some Iranian oil. What? What is this? Futures linked to the main US stock index turned lower as US and Israeli leaders attempted to quell market nerves over the potential for a prolonged campaign by the two countries against Iran. Ay, 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 okay? So, as you guys can see here, this is the S&P 500 chart. So, we can see that the market is going back to its levels, okay? So, let's go for a 4 hours chart that gives us a better insight about the market. Okay, yeah, so I understand I removed a potential support at this point. Then we have another one here. Okay, so we're deep inside the support level, and that's the weakest level we have seen in ages. I mean, the lowest point you are here was back in November. We are in March already, okay? So the market is going down, and the S&P 500 has been losing lots of valuations over the past few weeks. So we've been on a 4 week streak, and it's still going down, okay? And yes, let's see how the S&P 500 is doing. First of all, Wall Street set to open lower as Middle East turmoil clouds Fed outlook. The barrel of the barrel. So everything Mike Dolan and the RY team are excited to read. So the energy market is Iran's war. Iran was key theater of battle, and the damage is escalating. Yet financial markets are surprisingly well behaved. Expectations for more hawkish monetary policy weighted on Wall Street and European equities on Thursday, and the latter is set for its third weekly decline, but there is no sign of panic. So all is rising, inflation is back, so why are all equities still holding? What a great question, what a great question. These are the type of questions you always wait for, and this is a great question, okay? So this is the type of question you only get once a day, okay? So you might be a great trader to ask such a question. I mean, wow. So why are equities still holding? When we have a war going on, we have oil prices rising, and we have inflation rise. Because on the surface, it just doesn't make sense. If oil is rising, inflation rate goes up, well, the central banks stay tired, and the equities should at the most struggle. But the markets aren't that simple right now. And here's what's really going on, and let me tell you why. Oil doesn't equal full inflation signal yet. Yes, yet. Please be precise on the yen. Yes, oil is rising, but the market is asking, is this supply driven like geopolitics, cuts, etc., or demand driven like strong economy? Right now, a lot of the move is being interpreted as supply constraints, not overheating demand. So equities see not inflation is back, But energy shock is temporary. Also, the markets care more about rates, not oil. Equities don't react to oil directly. They react to interest rate expectations, and if traders believe the central banks are done hiking or even close to cutting later, then stocks can hold the rise even if oil goes up. Right now, the inflation fears are going up slightly, but rate expectations haven't exploded yet. So equities just stay supported. And this is key. The AI and mega cap liquidity is carrying the market. A handful of stocks like NVIDIA, Microsoft, Apple are all doing most of the work. These companies have strong margins that are less sensitive to oil and will benefit from AI capex boom. So even if macro worsens, indexes stay up because of them. Also, a lot of investors miss the rally and are underinvested, so the dips just get bought quickly. Also, we have passive flows and buybacks. It means providing a constant bid under equities, and then the soft landing is still the base case. Markets still believe growth slows but doesn't crash, and the inflation doesn't spiral. That's a sweet spot because it's not too hot and it's not too cold. So the equities just keep holding. And sometimes rising oil means the global demand is still alive. And equities like that. But up to a point, equities are stable only if this doesn't happen. When oil keeps rising, feeds into CPI, inflation accelerates, the central banks turn hawkish again. Then the rates explode, the valuation go down, and the equities crack. The equities are holding because all rise is still as temporary and supply driven. The rate expectations haven't shifted dramatically, and mega cap tech is masking weakness. So liquidity plus positioning are supportive. So that was a nice question, and thank you so much for your question, okay? So thank you so much for the question. And we move on here back to our battle of the battle. Good morning, Janet girl. How are you doing? Welcome, my dear. I miss you so much. Thank you for joining again. So, Israel Wednesday struck Iran's south port. Yes, few the world's largest. And yes, also Iran just hit Qatar's enormous Ras Al Khaimah liquefied natural gas production hub, which caused European gas prices to shoot up as much as 35% in one day. And we are officially on the doomsday scenario for energy markets. But even though oil prices in the physical market are soaring with the Strait of Hormuz monster close, the oil futures market is still at pricing in a lengthy crisis, while Brent crude reached a session high of 119 a barrel on Thursday. It ended the day around $108, and with West Texas Intermediate around $96. Investors may have trimmed the war risk premium, especially after Britain, France, Germany, Italy, the Netherlands, and Japan issued a joint statement on Thursday expressing readiness to contribute to appropriate efforts to ensure safe passage through the strait. All these countries, if you guys remember, have refused to join the war. Basically, they said, did you even tell us about the war when you went to the war? We had no idea, but then you went on it by yourself. Then you can just keep going by yourself. Why would you need our help? But now we can see that also these countries started to feel the heat and they're looking for a way to make sure all the major, we can say all the major ships pass safely through the Strait of Hormuz. US President Donald Trump also said they have told Benjamin Netanyahu not to attack Iran's infrastructure again because that's going to cause a big problem. Do you guys want us to see that see Brent crude hitting $200 a barrel? Because I want to see that. And mind you, Tehran has already threatened for that, okay? So they have no problem in making wrong go to that point. So we have a question. This narrative is strong, but price is unstable. That's a nice question. So this narrative is strong, but price is unstable, and is unstable is sentiment driving diversion from reality. Oh, what a question again. That's why I love you guys. Okay? You guys bring the best question out there and just keep on asking me the greatest questions online. Well, if you want to answer, you would say, hello, hello, I do Zainab. Thank you so much for your comment. Hello. So, if you would like to answer the question of Nadi, would say that we're actually spotting something very, very real and also very important. Yes, sentiment and reality are diverging in Tesla right now. So let's go to the Tesla stock price first, okay? So Zinab, how are you doing? How was your day? Thank you so much, really, for joining. Thank you so much. Please make sure to ask me if you have any question related to the stock market and also for the Tuesday market, the stock class, okay? Especially in the market conditions we have today. As yesterday, the market saw a huge demand. I'm good. What about you? I'm good. Thank you so much for asking. Thank you so much for asking. So, sentiment and reality are diverging in Tesla right now, but that doesn't mean the market is wrong. It means it's pricing a different timeline than you. So, to answer this question, so what the chart is telling you actually, you look at the recent price action, you have lower highs, unstable structure, and sharp intraday swings. That's not a clean bullish trend. That's narrative fighting flows. So the core issue is Tesla is not priced on today. Because this is one of those few stocks where price equals future story but not current fundamentals. And the narrative includes AI autonomy, like robotaxi they're trying to make, like self-driven technology, energy business expansion, and pet humanoid robots such as Optimus. So the investors aren't asking how many cars did I sell this quarter. They're actually asking what is Tesla worth if autonomy works, okay? So, why the price feels disconnected? First of all, the fundamentals are slowing. Reality side, EV growth is cooling. The margins under pressure and competition is rising, especially from Chinese manufacturers like BYD, etc. That puts downward pressure on price. At the same time, Eon keeps pushing AI autonomy vision. Market is an AI hype cycle, as I covered in today's video. If you still didn't watch it, please go and watch it. I covered great and insightful information that would help you in your trading, and that puts upward pressure on price. Also, the result equals instability. So you get bulls buy in the future, bears sell in the present, and this price creates a tug of war, and that's why it feels unstable. And this is classic narrative stock behavior. Tesla behaves more like a tech option on the future than a traditional car company. So, when sentiment is wrong, it spikes hard, but when reality hits, it just drops as fast as it can. There's no smooth trend, but just violent repricing. So, there's one key insight most of you are missing, even myself. So, the divergence isn't just sentiment versus reality, it's short term reality versus the long term probability. The market is pricing. Well, there's a chance Tesla becomes something much bigger than just a car company, like you can just imagine. If today's number don't justify it. But what would bring them back together? We have two ways actually. There's a bearish one and a bullish scenario. So I'll start with the first scenario actually, when reality wins, which is bearish, okay? So the autonomy delayed, the margins keeps falling, and the growth disappoints, and the price compresses hard. You can see that's like going back to levels like 240, 140, whatever, whatever. And then we have the second scenario where the narrative gets confirmed. The real progress in robotaxi, AI revenue visibility, and energy business scaling. So That's why I really believe versus evidence phase. Belief is very strong, but evidence is still mixed, and that's why price is unstable. So thank you so much, Lila, for the question. I really appreciate it. It was great to cover this question. You're doing an amazing job explaining this. Thank you so much. Thank you so much. I really appreciate your comments, guys. Thank you, thank you. So Zina, make sure that you would know more. You can just join my my WhatsApp, okay? It's in the first link. You gotta find out my bio, and then we're gonna help you to improve your trading skills. So welcome, teacher Cinema is waiting for you. You can just send me a message, and I will be actually happy to help you. So thank you so much for your comment once again. So let's move on to the next question. If I place an order, if I place an order, if I place an order to buy stock in pre-market. Okay, let me read it again. Wait. Okay, that's an important question. That's a good one. That's a good one. Okay, that's a good one actually. Okay, so I'll just drink some water, guys. So if I place an order to buy stock in pre-market and it does not get filled, will it continue into the regular market hours or will it cancel? That's a great question. That's a great question. Well, it depends on the order type and your broken settings. A pre-market order does not automatically carry into regular hours unless you explicitly allow it. Well, I would just say pre-market only order is present open, but toward day order it continues usually. That depends on broker settings and always double check. So the next question is, what is the impact of war on the stock market? That's a great question. That's a great question. The question you get once in a while, and when they hit you, you gotta answer in a very great way because one of the markets had a very, very specific pattern. Please help me here so I can explain it to you. And most people misunderstand it. It's not simply war equals market crash. It's more like uncertainty that drives us to shock, then to adaptation, then recovery. So let me break it down properly. First of all, we have the initial reaction. Oh, we have panic, sell-off, etc. When war breaks out, markets hate the uncertainty and investors reduce the risk fast, okay? So the result, you have stocks dropping, we have volatility spiking, and safe havens rise, gold, USD, and bonds. For example, when Russia-Ukraine war started, we had a sharp initial sell-off. Then something weird happened. Markets do stabilize. After the first shock, markets start asking, is it contained? Does it affect global growth? If the answer is not too much, the stocks often bottom and recover as soon as they can. And this is why market hate uncertainty more than bad news. So the real impact comes through commodities. War doesn't just hit stocks directly, it's oil, gas, food, supply chains. For example, when the Gulf War started, the oil spiked. The Russia-Ukraine war also give us energy and food shock. And this create inflation pressure and also margin pressure for companies. And yes, the central banks do complicate everything. If war, which means inflation rises, the central bank may stay hawkish longer, and that's bearish for equities. So the real truth is, war starting, commodities going up, inflation going up, rates going up, and then stocks pressured. And some sectors actually benefit. The winners, of course, are defense companies and energy stocks, and also, of course, commodities. So the losers are airlines. So because, as you guys know, since the war started, more than 50 carry flights have been cancelled through in and out the Middle East. And yes, the consumer discretionary and the global trade dependent companies. So the big insight most people miss. Markets don't price the war itself. They price duration, escalation risk, and economic slipover. So we have different types of war, which equals different market impact. First of all, local content conflict. It's a short-term dip and has fast recovery. Then we have regional escalation, such as Middle East or Taiwan risk. Oil shock, inflation risk, more volatility. Then we have global systemic war. It's major prolonged than bear market. So historically, in many wars, it equals by the dip events, but markets often recover before the war ends because markets are forward looking, by the way, and war impacts markets through three channels: sentiment shock, commodities and inflation, and then policy response. So the question is not, is there a war? The real question is this war changing inflation and interest rates? So the next question, Microsoft is fundamentally strong, but price is consolidating. Is this accumulation or distribution? Well, that's a great question. That's a great question to ask. Well, this is a high level question because consolidation can mean either accumulation or distribution. And with Microsoft, it's not obvious at first glance. And let's break it down like a trader, not a textbook. What we've seen first, from the chart behavior, price moved up strongly before, now moving sideways, and then slide downward drift recently, and that's consolidation after a trend. Then, accumulation, the start smart money is buying quietly. It happens after a move or during a pause, and the price stays stable despite selling, which leads to breakout higher. Then we have distribution, for example, smart money is selling into strength. The price stops going up despite good news and realize gets sold, which leads us to break down lower. So what is Microsoft doing? Right now it looks like more like accumulation than distribution, but not clean. Here's why. You have strong fundamentals still intact, cloud growth, AI integration, and massive cash flow. There's no fundamental breakdown. And also you have no sharp breakdowns, no heavy trend reversal, which suggests sellers are not in control. Then, even with volatility, the price isn't collapsing, and that's often absorption of supply. So, we have lower highs recently, each bounce slightly weaker, which could mean buyers losing momentum. Then we have market rotation, money is shifting between AI leaders, cyclicals, and energy. So, Microsoft might just be resting while money rotates elsewhere, and the valuations are cheap. We have institutions that may follow trend positions and not aggressively add. And the two's most accurate answer. This is likely neutral consolidation with a slight bullish bias, not pure accumulation and not clear distribution. It's more like market waiting for next catalyst. So, what decides the next move? It's bullish breakout. If AI revenue accelerates and strong earnings surprise, market stays risk on. And bearish breakdown. If rates rise again, tech sentiment weakens, and growth disappoints. So how traders evade the setup? Instead of guessing, they watch the range. Break above resistance, which was accumulation. Break below support, which was distribution. So you cannot confirm accumulation or distribution during consolidation. You already know after the breakout. So here's a clean takeaway. Fundamentals are strong, the price is rested, and structure is on the side. The translation, big players are positioning, but not revealing direction yet. So that was a great question regarding Microsoft, okay? And here we go back to our stuff, okay? So we go back to analyzing the stock market and how the news are affecting the global market. So let's go analyze how is the grain doing, by the way. I didn't check today. Oh yeah, still the same thing. I mean, at least the situation I told you guys yesterday didn't happen, thank God. So thank God the situation of yesterday didn't actually happen. At least that's good. Stacks and lower. In choppy session after Netanyahu says Iran can't enrich uranium. Oh, that's a good question, Zainab. That's a good question. Would you consider this a good buy opportunity for gold? So let's check it out first, okay? This is gold, and let's check it out. It can be a good opportunity, but only depending on your time frame. Because right now, gold is in a very tricky phase. So gold recently dropped sharply from highs, became volatile despite war, and is reacting more to interest rates than geopolitics. And this is the key shift. Gold fell hard as rate cuts expectations disappeared. Strong dollar plus higher yields are pressuring it. So, is this a buy? Well, long-term trend is still bearish. Many forecasts expect gold around 5,000 to 6,000 in 2026. Structural demand is strong, yet central banks buy it, geopolitical uncertainty, and inflation over time. And this supports the idea that dips are buying opportunities. And rates are the real driver now. Higher interest rates are bad for gold. The gold gives no yield, and that's why it's fallen even during the war. So, investors expected rate cuts, which are now less likely. The funds are reducing gold exposure, and in the short-term trend, momentum is down and could still have another leg lower. So the real answer is gold right now is long-term bullish, short-term uncertain, and slightly bearish. So how smart money plays this? If you are a long-term investor, yes, this can be a good buy zone, but scale in. Don't go all in. This is really important. Thank you for your answer. I wouldn't know what to do without you. Oh, thank you so much, my dear. Thank you. Thank you. So, in a short-term trader, it's not a clean buy yet. You should wait for price stabilization or a clear reversal signal. So, in long term, it's bullish. In short term, it's unstable. But strategy is scale in. Don't just change. How does AZTR look for you? Oh, AZTR. I don't trade it much often, but I know I have friends that do trade in AZTR. I can bring them to this slide and then maybe you can ask them. So, it's not an early investor. It's a high risk, biotech, multi type stock. Actually, it's a it's a tiny biotech. Its market cap is roughly 5 million. There's no real revenue and it's still in early clinical trials. It has only 12 employees, so this is basically a science project that might become a business. So why the stock looks weak? First of all, there's a massive downtrend from $3 to 0.2. That's more than 90% collapse. It's not random, it reflects real issues. It has losses every year, negative cash flow, and very low cash reserves, just 1.4 million at one point. And this is range dangerous because they constantly need to raise money. And they have multiple share offerings, warrants issued, and reverse stock split. That's a huge red flag. Existing shareholders keep getting diluted. After already received bank compliance notice from NYSE. That series means if it's all improve, it could get kicked off the exchange. So why do some people still buy it? Because of this, the biotech lottery narrative. If one drug works, the stock can go 10 to 50 times more. This is such a valuable life. Thank you, Selena. Oh, my dear. Thank you. Thank you so much. Thank you. Oh my god, your comment is so thoughtful. Thank you so much, my dear. Like, I really appreciate it, honey. Thank you. So, that's based on if everything goes perfectly. In the technical view, right now, prices near all-time lows. There's no strong trend reversal, and there's weak momentum. But this is not accumulation. This is more like dead money, unless catalyst hits. The only thing that matters for AZTR is that charts, not fundamentals, but clinical results, specifically HER12 trial results, which is coming. So you should think of AZTR as a bet. Okay, if you have a drug that works, then that's gonna be a good sign. But my honest take, if you're asking from a serious investing perspective, no, this is not a quality setup. So there's another question: is the market ignoring reality? I mean, that's a thoughtful question. That's a philosophical one, even. You can say it's more philosophy than just a normal question. Well, it's not ignoring reality. You're doing an amazing job explaining this. Oh my god, honey, thank you so much. Thank you, thank you. This is why I'm doing this. Like, I'm just doing this for the love of you guys and for the love you're giving me in my live streams. I mean, wow, thank you so much. Keep going. Oh my god, thank you. I will. Thank you so much. Well, going back to the third person question, is the market ignoring the reality? Well, it's not ignoring reality, but it's rising a different one. That's the comfortable truth most people miss. Why choose that the market is ignoring reality? Right now you're seeing inflation risk creeping back, mixed economic data, expensive valuation, but yet equities are still holding. So it is irrational. But here's what's actually happening. Markets price the future, but not the present. The market is asking, where will things be in 6 to 12 months? Now what's happening today? So even if inflation ticks up now, if investors believe it won't last or growth stays solid, the stocks can stay elevated. And there are multiple realities. Right now, there's two narratives that exist. First one, there's reality A, which is bearish. Inflation resurging, rates staying higher, and margin getting squeezed. The reality B, which is bullish, AI drives productivity, growth hunts up, and inflation doesn't spiral. The market is currently leaning toward reality B, which is bearish, and liquidity is distorting signals. This is huge passive investing like ETFs, buybacks, institutional flows, and this creates constant demand even when macro looks shaky. So price doesn't fully reflect fear. Since 2020, markets have learned policymakers will step in if things break, and that creates higher risk tolerance and faster deep buying. So, stocks like NVIDIA and Microsoft are carrying the index, but these are prices on future dominance but not current micro noise. But we're not wrong, actually, we're not wrong, because there is a difference. Market strength is fragile because it relies on a few stocks. It assumes a perfect scenario, it's sensitive to rates. But when reality catches up, markets don't ignore reality forever. They reprice fast. When inflation surprises higher, rates spike and earnings disappoint, and then you get sharp corrections. So the market is not ignoring reality, but discounting a more optimistic future. So the question isn't, is the market wrong? It's which reality will win. Oh, that was a good question. That was an interesting one. Thank you so much for the question. So, guys, I'll just go to the toilet and come back, okay? Thank you so much. Dude, please just stay with me 1 minute and I will be back. So guys, I am back. Thank you so much for waiting for me. Thank you, thank you, thank you. So next we're gonna move on to the other question we have from Janet, okay? So Janet just asked us a great question. Let me just charge my phone, guys. And I will be answering Janet's question next, okay? Here. Okay. So Janet just asked us a great question. Janet and Jing also asked us a great question. But let's start with Janet. Could you say a few words about gold? It has been a steady decline. While gold's recent decline looks strange at first, especially with geopolitical tension, but it actually makes sense once you look at the real driver. Gold follows interest rates more than headlines. So what's behind the drop? We have higher yields, which means pressure on gold. Gold doesn't pay interest, so on a bond yields rise, real interest rates go up. Investors prefer income-generating assets over gold. And then gold is priced in USD. We have strong dollar where gold becomes more expensive globally and the demand weakens, and that pushes gold lower. Rate cut expectations faded. Earlier, markets expected aggressive rate cuts, but now cuts are delayed or uncertain, and that's a big negative for gold. So, why it feels counterintuitive? Normally, when a war, we have gold going up. When a risk, gold going up. But right now, macro, like rates, are higher than geopolitics. So even with tension, gold can fall. So correct, gold is correcting within a larger bullish structure, but not necessarily a full trend reversal. So what to watch next? Gold's next move depends on interest rates. When rates will go down, the gold will rally. Or rates go up, the gold will struggle. Also have inflation direction, have persistent inflation, have bullish long term. Then controlled inflation, which means neutral or weak. The financial stress spike, which means gold catches a bit faster. So gold doesn't move on bad news. It moves on policy response to bad news. So in the short term, it's really weak momentum. In the medium term, it's uncertain. But in the long term, it's still bullish. So if you want a clean take, gold isn't broken. It's being repriced for by higher rates. Oil stocks are rising. The macro is unstable. That's a great question, Leon. That's a very, very great question. Well, when stocks rise, when macro is unstable, it usually means the market is running on assumption, but not confirmation. But that doesn't mean it's wrong. It means it's fragile. So what's happening under the surface? First of all, the market is pricing a perfect scenario. Right now, equities are basically betting on inflation that doesn't come back strongly, central banks that don't hike again, and the growth slows but doesn't break. And also AI that keeps earning strong. So that's very narrow path. The price is driven by few giants. Indexes look strong, but it's heavily influenced by names like NVIDIA, Microsoft, and Apple. So it feels like all stocks are rising. But in reality, a few stocks are doing most of the lifting. Even with instability, we have passive flows keep buying, buyback support prices, and investors chase performance, and that creates a constant bid. And the market is forward looking, but maybe too optimistic. The market is saying, yes, things are messy now, but they'll be fine soon. And that's why we see bad news is in crashing stocks, good narrative like AI growth dominate, and this is where risk builds. When macro doesn't equal price, you get complacency, and that leads to overvaluation, weak positioning, and sudden sharp correction. So what could break this setup? Just rally holds only if nothing goes wrong. It breaks if inflation surprises high again or keeps rising, which means feeds CPI. And this is not a healthy rally, by the way. It's a liquidity-driven, narrative support rally in a fragile macro environment. Instead of saying, well, this doesn't make sense, think, what is the market assuming? And what if it's wrong? When stock go up, that means optimism. When macro is unstable, that means risk. But when there's a gap between both, that's opportunity and danger. Markets can stay disconnected from reality, but only until reality forces repricing. And when it does, It's usually fast and painful for the wrong side. So that was a great question. But I want to look ahead at what's happening next week in the economic calendar. So we have a better look at what's going to happen next week. That's going to be great. So nothing much on Monday. But it's a big week for the S&P, okay? It's a big week for the S&P. On Tuesday, the service PMI release is published monthly by Market Economics. The data are based on surveys of over 400 executives in private sector services, service companies. The surveys covered transport and communication, financial intermediaries, business and personal services, computing and IT, then hotels and restaurants. An index level of 50 denotes low change since the previous month, while a level above 50 signals an improvement and below 50 indicates a deterioration. So we seem to have low forecast, but I think it's going to be a low. It's going to be a lower this time. And then we have the Fed Vice Chair for Supervision Board speaks. Also have the API weekly crude oil stock. Something happens every day. And for Britain, okay. Then we have export and import index, then the crude oil inventories again. Yeah, that's a normal week, okay? For HK, you have imports and exports and trade balance of February. Initial jobless claims, and we have a interest rate decision for South Africa. Then on Friday, yeah. So we don't have much going on this week, okay? We don't have much going on. So let's check on the latest news, okay? Oh, that's a huge and important thing here. So NVIDIA confirms 1 million GPU sale to AWS through 2027. Oh, okay, that's a big one actually. So NVIDIA confirms 1 million GPU sales. It should deliver 1 million graphics processing units to Amazon.com, AWS cloud computing division between 2026 and 2027. An executive confirmed to Reuters, marking the first official timeline for a major cloud partnership that includes a broad array of chips and networking equipment. NVIDIA's vice president of hyperscale and high-performance computing told Reuters the GPU deliveries would begin this year and extended through 2027. NVIDIA obtained through a $17 billion licensing deal with AI chip startup Broke in late 2025. Wow, that's a huge deal for NVIDIA. So here we go back to the news and let's check it out. Is there anything new that's going to happen in the next week or not? Well, Iran conflict clearest. Oil choppy amid worries over energy infrastructure attacks. Brent crude futures were last hovering around $108 a barrel. The global benchmark surged roughly $119 per barrel earlier this week, following Israeli strikes on a key Iranian gas field and retaliatory attacks on natural gas sites across the Middle East by Tehran. The exchange of bombardments on major energy infrastructures has fueled fears that even if the US and its allies are successful in attempts to reopen vital naval ships to lanes shipping lanes through the Strait of Hormuz, south of Iran, supply disruption will stay in place over the long term. Qatar, whose major natural gas production facility, Ras Laffan, was hit by Iranian strikes, has said that its export capacity has been reduced by 17% and will take as many as 5 years to repair. The country is a major gas exporter, especially to Europe. Oh, we have already seen this before. Oh my god. We have already seen this one before. So let's answer one of those questions we have here. So Suki, thank you so much for asking many questions. So commodities are moving, but growth stocks stagnate. Which trend is real? That's a great question. Thank you so much for your question. Well, it's a very sharp observation because you're basically seeing two opposite macro signals at the same time. You can see commodities rising, which equals inflation and debt cycle, growth stocks holding, which equals disinflation and soft landing. So your real question is which market is right? First, you have to understand the conflict. Commodities are saying demand is strong or supply is tight. Inflation risk is coming back, and rates may stay higher. That's typically bad for growth stocks like Nvidia and Microsoft. They're both saying future earnings will be strong, AI and productivity will offset macro, and the rates won't rise much more. But that's bullish and that's soft landing narrative. So, which trend is real? Well, right now, it's neither fully. The market is in transition, and this is what's happening. We have two narratives that are fighting. First one is commodities rise. Inflation escalates, central banks stay tight, and growth slows. So the growth stocks should fall. Narrative B, inflation stays controlled, growth remains resilient, and AI drives earnings. And that's commodities trend that's fading or stabilizing. So the market hasn't decided yet, and that's why things feel off. Well, why both can rise temporarily, and this is key. There's two different drivers: commodities, current supply demand shocks, and the growth stocks, future expectations plus liquidity, and they are reacting to different time frames. So growth stocks have an extra boost. AI is distorting the normal cycle. Stocks like Nvidia are not behaving like typical growth stocks because they have real revenue acceleration and massive capital inflows. So they can both stay strong even if macro is messy and eventually one side wins. These diversions does not last forever. And if commodities are right, the inflation rises, rates go higher, and growth stocks reprice lower. So if growth stocks are right, inflation stabilizes, rates fall or stay stable, and commodities cool off. So how to tell who's winning? You should watch interest rates and inflation data and also market breadth. If only a few stocks hold, that's weak rally. But if everything rises, there's a healthier trend. So right now the market is split between present reality and future expectations. If commodities equals present stress, growth stocks equals future optimism. And this is not a confirmation, it's tension. And tension in markets usually leads to a sharp move once clarity comes. If you want, I can turn this into a strong value idea. Is money flowing into crypto itself or just into speculative assets around it? That's a great question, Zuki. Zuki, thank you so much. Where do you even get those questions from? They are great. They are great questions. Well, core, what you're seeing in crypto is a classic bifurcation between real crypto and speculative hype. So, in simple terms, most of the money isn't going into the core assets themselves. It's chasing speculation around them. So, let me break it down. Bitcoin is often called digital gold. It's still the main store of value. Ethereum is a main layer for smart contracts and has real utility. Money flows here are relatively steady. Institutions buying for treasury or portfolio diversification and long-term holders accumulating on dips. And there's a flow pattern also, slow, strategic, and not hype-driven. Then you also have speculative crypto assets. These include meme coins, new DeFi tokens, and layer 2 projects promising insane APYs. AI and Web3 hype coins also. So here's what's happening. Retail fear of missing out dominates. Short-term hype drives price swings, and liquidity is very sensitive to sentiment. And there's a flow pattern. It's fast, volatile, and often not tied to fundamentals. And why choose like crypto is pumping? When you check headlines or price charts, you see massive jumps in crypto. But BTC and ETH dominance is flat or only slowly increasing, meaning the apparent rally is largely speculative noise. Indicators to confirm the flows, and also core crypto is slow moving and cautious. Speculative assets are fast moving and volatile, so most of the recent rally headlines are driven by speculation, not adoption of fundamentals. So crypto itself is not getting as much new capital as headlines suggest. But what's driving the excitement is speculative assets built around crypto, but not the foundational coins. So that's a great question. So this was a great question asked by Suki. Thank you so much. Thank you for the great things you have asked us about. They are so great. So let's analyze it for her. Like she said, help me analyze into. So what into actually is. There are two related unrelated things that sometimes get confused in crypto. A Web3 protocol called into this is a blockchain. There's a into coin, okay? While Introcoin is promoted as a digital cash, privacy cryptocurrency with wallets, mining, P2P privacy features, it's trading on tiny exchanges like Trade.org and React, not on major venues. So there's pros and cons. This is not a blue chip crypto investment. Well, Nali asks us a great question. Retail participation is high, but brokers aren't exploding. Is activity weaker than it looks? Exactly. You spotted a subtle but important divergence. High retail participation doesn't always equal strong market activity. Well, The type of flow and liquidity really matters, so let's break it down. We have retail versus institutional flow. We have retail participation is high, lots of accounts buying and trading, social chatter and app downloads are surging. We have meme stocks, small caps, and crypto hype coins are showing big volume spikes. Black reports and institutional flows aren't exploding, like ETFs, mutual funds, pensions, hedge funds are not increasing exposure significantly. Professional traders are cautious, and this is a real red flag. Retailers active and while activity can look stronger than it is, we have small ticket trades dominate many accounts by $50 to $20 worth, creating volume illusion. Then high frequency trading, algorithmic overlay. We have retail order flows that are often amplified by HFT, making volume look bigger. Then concentration in few names. Indexes rise because 3 to 5 mega caps lift the average. Most other stocks are flat or weak. Even if retail is active, liquidity is thinner than headline volume. Price swings can be exaggerated and market breadth is narrow. Then risk is hidden. Essentially, the market looks hard on charts, but most of the activity is concentrated, small, and fragile. Short-term rallies can still happen, formed by retail fear of missing out, but fragility is high, and micro shocks or institutional pause can trigger big drops. Markets aren't fully healthy, but just temporarily buoyed by hype. So how to tell if activity is real? How to check market breadth? Are most stocks advancing or just a few? You should have ETFs inflows and institutions actually buying and options open interest. Is there serious speculative money betting on a move? Then volume by price and liquidity. Does high volume correspond to strong, meaningful trades? If retail is high, but these aren't rising. The activity is weaker than it looks, so the market feels hot, but the underlying strength is shaky. Retail alone can't carry it, and still institutions participate, or liquidity widens, and the trend is fragile. So that was a great question by Selena. Which listed company do you like best? Okay, let me show you. That gotta be Broadcom. Okay, the volatility here and the market conditions are great. Just look at it. For example, if you go here, you have these amazing support levels that show you a lot, and the company is so clear to its investors. It shows you everything related to what they do. Like everything is transparent and everything is shown to the investors. So it's clear and you know what's actually happening inside this company. Then you can see here also it's still on a bullish trend, but it became haunted on the past few days. There's consolidation happening throughout this move. So as you can see here, there's a great consolidation as as you can see here, the other support level at roughly 308. The market went, touched it, and then it's going up again. So the correction is working perfectly in the size. So as you can see here, the market is showing a special trend. Okay, so if we go to oil, for example, here, we can see that it's still going on the same direction, but then you can see something is weirdly happening here. And just like the market is being rejected many times. So let's check it out Monday and see what's going to happen actually in this place. I like Vosk, so I bought Tesla. That's a great one. That's a great one. That's a great one. Okay? So it's very great what you did. And you can keep going on with what you did. That's very great. So this is a Tesla short. And yes, this patcher didn't actually get executed. So we can still wait for confirmation, but we are on the support zone we have actually made last time. So let's wait and let's see how is it going to be moving on, okay? So this is the chart we have here. And as you can see, the market is still moving here, okay? So if you guys have any other question, please let me know in the comment section. Hello, Ask Lane. How are you doing? Thank you so much for joining. Thank you so much. Hello, do you have any question about the US stock market? Please let me know in the comment section. We have analyzed many stocks today and we are still on live. So if you got any question for me, just please do let me know in the comment section. And thank you once again for joining my live stream. So did you buy Circle because you understand stablecoins or because you think it follows Bitcoin? Well, I actually didn't buy Circle. I didn't buy Circle actually, okay? So in my portfolio, I don't have Circle. So, maybe you're asking the wrong guy for it. But I can give you a quick analysis on how Circle will be doing in the next few days. So we already have our support and resistance zones here. So as you can see, we're reaching the resistance zone again. And I think it's the only performing stock at the moment. If you go to any other stock, you're going to see that they're all going on a bearish phase, except on except for Circle. What's today's move on S&P? Wow, thank you so much for the question. LESC, thank you so much for the question. 1312, thank you so much for your question. Well, if we go to the weekly chart, you can see basically that we are on the fourth week on the red candle. So we have moved from 6,900 to 6,500 today. The lowest we have been in since November. And that's very bad for the market. So we're on the lowest we've been since November, and that's actually bad. So unhealthy for the market. Why? It was mostly driven by AI hype that's kinda ended, and also the Middle East conflict happening these days. So for the S&P, I think we should still wait for confirmation before taking a new move because as you can see here, we're reaching the lower than the point where we have been rejected once on Friday 21st November. So if you can still wait until you see a great pattern, then that's going to be a great move and you can buy, okay? Do you think that SPY stocks can be a long-term investment? SPY stocks? Never heard of that before. Hmm. Okay, but next move on to the Nasdaq Composite. As you can see here, we can see a pattern happening in all the major indices and all the major stocks. You can see here, bullish trend, then going down, consolidation. Same thing for Nasdaq, going up, consolidation. S&P, going up, consolidation. Apple also going up, then you can see a consolidation again. Same thing for Tesla. Same thing for Netflix since I think a year or month. So all the major stocks and indices are having the same problem these days. They go up and then they stay consolidated on a special level in between the support and the resistance zone. So as you can see here, if you want to make a position, you should still wait for a perfect signal, okay? So if you go back to oil market, it's still going up. It's been a while since the market is going up, but if you go and see on the weekly chart, wow. I mean, we started this week at 201, but now we're back to 96 at least. That's we can't even name it improvement, but it's okay. You can name it whatever. Same thing for gold. It's suffering. We went from 5,600 back to this level. So third week in a row, and gold is still suffering. Okay. So that's very bad for the market. That's very bad for the market. So before we end this live stream, let's go through the latest news of the market these days. Okay. Today, sorry. We've been through already, but let's have a quick look again. So, major key points to discuss today are where the stocks go in, how to trade, how to not be trapped by retail traders, by institutionals, and also what's next for crude oil and how microeconomics are not the only players in today's market. Well, if S&P 500 drops, I just think I have to wait more until it gets confirmed on this level. Before I take my position, I have to wait for clear signals before I get to the market, okay? So I have to wait until there's a clear signal to like actually get in. But for now, I think that's still way too early to decide whether to go in or not. So there's an important news coming out right now. US deploy of thousands of additional troops to the Middle East. The US military is deploying thousands of additional Marines and sailors to the Middle East. Three US officials told Reuters on Friday. One of the officials, speaking under condition of anonymity, said that USS Boxer, along with the Marine Expeditionary Unit board, were departing with the west coast of the US about 3 weeks ahead of schedule. So this might be a we might see more drama happening there. And that's why I'm saying, please stay cautious. Wall Street slips as Middle East turmoil clouds Fed outlook. The main indexes of Wall Street slipped on Friday as Iran approached its fourth week. Rolling energy markets are prompting investors to aggressively reprice bets on the Fed Reserve's interest rate cuts. The conflict in the Middle East showed no signs of easing as Iran attacked an oil refinery in Kuwait, and the report said that the Trump administration is planning to occupy or blockade Iran's Gog Island to pressure Iran to reopen the Strait of Hormuz. Investors also weighted major nations' efforts to ease energy supplies. Brent prices wobbled throughout the day and were less at 108 a barrel. FedEx, often seen as a barometer of business activity, issued upbeat forecasts and said global demand was holding steady despite geopolitical tensions, sending its shares up 3.4%. Okay, that's good for you. So, as you can see, there's no signal. The market is going to be recovering in the next few days. But that's what we hope, okay? That's something we all hope in today's market. So, let's have a live recap, okay? Equities versus macro. Stocks are holding, but macro signals are fragile. The market is pricing a soft landing, future optimism, but not today's reality. Mega cap tech like NVDA and Microsoft are carrying the indices. Growth stocks are holding, but the trend is fragile. Momentum depends on earnings and rate outlooks. Commodities are moving, signaling inflation risk. Gold is in short-term decline due to strong dollar and higher yields, but long-term bullish case remains. Money is flowing mostly to speculative assets around crypto and large core BTC ETH accumulation. Projects like Into have real tech potentials, but tokens remains high risk, low liquidity bets. So markets feel strong, but the key takeaway, by the way, the market isn't ignoring reality. It's discounting an optimistic future. In the short term, we are fragile and narrative driven, but in the long term, the fundamentals will eventually prevail. The markets feel strong, but the undercurrents tell a different story. So stay alert, watch the catalysts, and always separate the hype from real strength. So thank you guys for joining today's live stream. I really appreciate having you guys here today. It was a great session with you all. And yes, I'm gonna see you guys on the next live stream on Monday again. So thank you. Thank you so much. And I hope you have a great end of the week. So if you have any other questions, please make sure to text me on WhatsApp. You can find it on the bio and also in the first comment here. So thank you guys and have a good day. Have a good weekend. Enjoy your time.